And the Mortgage Minute brought to you by our friends at Geneva Financial. Yesterday, we got all kinds of data came in after our broadcast time. The Federal Reserve. So you get all of these reporters that go in, and unfortunately, we've gotten to the point nowadays, and that most of the media, they just have no clue what they're talking about. And they have to be schooled in areas that they ought to get people that have a clue as to what it is. But Jerome Powell yesterday, who is not an economist, he's a lawyer, had to try and educate people on economics. Figure that one out. So he admitted yesterday, he being chairman, Federal Reserve Chairman Jerome Powell, admitted that Fed policy is restrictive. Unbelievable. He said that the quit rate for the job on the jobs report is lower. Job openings are lower, but still above those unemployed. Wage increases are slower. Think about this. Now, all these things are going on, and he's thinking that we need to keep interest rates low. Labor market discrepancy between the... So this one we talked about. Finally, Jerome Powell is mentioning this. We've been talking about this on Ron Siegel Radio. So the labor market discrepancy. That's lawyer talk for the Bureau of Labor Statistics has no friggin' idea of what they're talking about. And they come out with numbers that make absolutely no sense. So the differences between the Bureau of Labor Statistics, which is a model, they don't talk to anybody. They probably only use a donkey to try and figure out what their numbers are. But the household survey, they actually talk to people and find out what's going on. Could argue that, according to Powell, they could argue the business survey may be overstated.
Surprise, surprise, surprise.
Now, we gave you all these numbers last week when we started talking about this, or earlier this week, when we're talking about the numbers that came out where they tell us that the birth-death rate model, which is how they identify small businesses hiring and or adding to the jobs market. They come up with adding 200,000 some jobs, yet ADP, who pays these people, lost 10,000 jobs. So do you think there's a discrepancy in there? Bureau of Labor Statistics adds 272,000 jobs. Household survey says we lost 480,000 jobs. But Powell didn't even mention the birth-death rate model. No mention of it. Now, what is Powell focused on? Inflation. Modest further progress from a lack of progress. Acknowledged shelter lag. We've been talking about that for a long, long time. The year-end core PCE estimate higher, 2.8% from 2.6% due to replacements. This fascinates me. If you listen to Ron Siegel Radio, we talk about these replacements all the time. Yet the reporters didn't know what replacements are when they had the Fed statement yesterday. What are replacements? Well, if you're looking at a year-over-year number, what you do is you take out, for instance, we're in June, you would take out the June numbers of 2023 and replace them with the June numbers of 2024. So you look at what the replacement number is going forward, kind of gives you an idea. Well, if you've got a real low replacement number, anything is going to cause a negative effect on inflation. There are certain months where we've got like a 0.2 or 0.3 replacement or 0.1 replacement. And if we get a 0.2, that means even though inflation is still low, the replacement factor means inflation is going to go up. So we got all that garbage from the Federal Reserve yesterday. You look at the dot plot. The Federal Reserve basically says we're going to have one more rate cut throughout the rest of this year. We need more than that. The issue is the Federal Reserve cannot control what's happening in the marketplace. They try to with the interest rates, and they're trying to deal with inflation through these interest rates. But when you've got a 0.27% inflation rate on the numbers that the Federal Reserve has any authority or control over, you're not going to have a big effect by having higher and more restrictive rates. But Powell doesn't see that. He's not that smart, apparently, or they never taught him that in law school. Well, why would they? That's not something you study in law school. Think about some of these things. If you take out shelter, which regardless of what we do in our house, most of us want to live with a roof over our head. It does cost extra to have a roof over your head. Most of us don't want to live in that Coleman tent. There's the idea. So does having higher interest rates affect that? Well, it might slow things down on the way people can get a house. Maybe there's more people that can't afford it. Motor vehicle insurance. Does the federal, you've got to have it. Now, unfortunately, in a lot of cities around the country, the theft and vandalism and criminal activity is up. Of course, motor vehicle insurance is going to go up if you've got these things going on. The Federal Reserve can't control that. When we take motor vehicle insurance and shelter out of the core PCE, we're down at like 0.27%. The Fed wants 2.4. That's almost 10 times, or 2%. That's almost 8 times where we are right now, higher. And as we see more and more people becoming unemployed and more small businesses saying they're not going to hire anybody, what do you think Powell's going to do? They're going to be behind the 8 ball again. And when we come back, I'm going to continue this conversation on where we are, because maybe the National Bureau of Economics might realize what I've been telling you right along, is that we're already in a recession. And I'm going to tell you about the 4 main pillars that the National Bureau of Economic Reserve, or NBER, they're the ones that call recessions. There's 4 pillars of what they look at every day at this time. OBMMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. What did rates do yesterday? We like seeing red arrows when Josh puts this one up on the screen. 30-year conventional loans down 6.845. 30-year jumbo loans down 7.081. 30-year FHA loans down 6.652. 30-year VA loans down 6.328. 30-year USDA loans 6.659. OBMMI does not tell us points paid, points received, and they don't tell us the APR. They tell us the number you need to put in your mortgage calculator if you don't have one. ronismylender.com. You can get our mobile app, ronismylender.com. If you want our market commentary, our thoughts, we put that out each morning as early as the data allows, rsrmarketminute.com, rsrmarketminute.com. Let's see what the markets are doing today. We'll look at it, and we see that the S&P 500 is down 9.31 right now as we speak. We're looking at the 10-year Treasury yield down 8 basis points. Mortgage-backed securities, bond, up 17 basis points. When the bond goes up, the yield goes down. Just mathematics. That's the way it works. And as we've been talking about what's going on, what's driving these things, I continue with some of the thoughts and things that we're looking at. So I was mentioning to you a little bit about NBER. They're the ones that actually tell us whether we're in a recession or not. There's 4 main pillars on a recession call. Real personal income, excluding government transfers, peaked out in January, so it's been going down ever since. Jobs, household survey employment, peaked last November. Non-farm payrolls employment, it is at a peak. Industrial production, and we did see finally an increase in, or realism in the first-time unemployment numbers that came out. Remember that this has been a funny one, because initial jobless claims mysteriously were running at like 212,000 every single week. Well, now they're at 242,000 is what they came out. Maybe they're finally looking at the real numbers instead of just putting something on paper. I digress. Industrial production peaked in September of 2022. Real business sales peaked last December. If you've been listening to us for any length of time, I told you that it was my opinion, and should be yours too, we went into a recession October of last year. That's when we look back and we see that the real numbers were saying recession, and they were blinking high. Nobody was paying attention. Producer Price Index report, which measures wholesaler production inflation, fell 0.2%, much lower than the expected. It fell 2%. They expected it to go up by 0.1%. Year over year, producer inflation fell from a downwardly revised 2.3% to 2.2%, lower than expected 2.5% expected. The drop in gasoline prices helped the headline come in negative. Unfortunately, they have to use California's numbers, and we like to pay more. Core rate strips out food and energy prices was 0% in May. Goose egg. Much lower than the 0.3% expected. Year over year, core PPI fell from 2.4 to 2.3, which was lower than the 2.4 expected. Services inflation, which is where most of the inflation is coming from, came in at 0%. Now, when I say PPI, what is PPI? That's the producer price index. Producers make the stuff, and they send it out to consumers, and then that goes into the PCE, personal consumption expenditures, or the CPI numbers. And the PCE is the Fed's favorite measure of inflation. So that is give you a little bit of background on what's going on in the mortgage minute. That's what's driving the mortgage rates. And remember what I've shared with you. Strategy beats rate always. Strategy beats rate always. That's why I've been talking to you so much about the Home Select loan that from our friends at Geneva Financial, because it might have the highest interest rate of any loan on the market, but the dollars coming out of your pocket for interest are the lowest potentially of any in the market. That's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make a call, 800-306-1990, 800-306-1990.